The reason is in the 70s, bonds were mispriced relative to stocks. And Ron's observation was everybody that used interest rates came up with much higher values. And so they were buying into a declining market. When Ron, he used, inflation, he came up with much lower values and he was sitting on his hands waiting for the value to come around. So our observation, and he's since written about this and basically taught me, bonds can be mispriced relative to inflation. So if you plant your feet on bond prices, you may be wrong. And frankly, that's what we saw this year, right? Bonds have been mispriced relative to inflation now for about a decade, and it got worse this year and finally caught up to them. So that's why we use it. If you think about it, right? If you've got a company that's growing its revenues at 5%, in a 2% inflation environment, you're saying, okay, well, they've either got pricing power or they're taking market share. In a 7% inflation environment, you have a completely different conclusion if they're growing the revenues at 5%. Now you've got to conclude they don't have pricing power, right? So if you're not taking inflation into account, you get a very different view of what's happening in a company. That's another way of looking at it.